let's start off with the Fed, because that is obviously going to be the most important situation here going forward to the end of the year. I really initially listened to their minutes. I didn't actually initially read them. And my take on it was that it might be a little bit more hawkish because they didn't touch upon the dollar concerns, and they didn't touch upon really reaching their inflation target, at least on my first read. However, I actually really physically read the statement, and I changed my mind. I actually think that the statement was pretty dovish. And let's go over why. Here is the statement. I have it pulled up. It is, for some reason, very small, so I'm going to be straining to see it. During their discussion of economic conditions and monetary policy, participants focused on a number of issues associated with the timing and pace of policy normalization, meaning rate hikes and the speed of the rate hikes. Incremental, like quarter of a point, half a point, so on and so forth. Some participants thought that the conditions for beginning the policy normalization process had already been met, which would be more hawkish. Most participants anticipated that based on their assessment of the current economic situation and their outlook for economic activity, the labor market and inflation, these conditions could well be met by the time of the next meeting, which we all know is impossible. There's no way they're reaching the 2% inflation target. That wasn't possible by their past meeting, and since then the commodities, actually there's been more deflation, so they're even further away from that target than they thought they were at that meeting. Let's continue. Nonetheless, they emphasized that the actual decision would depend on the implications of the medium-term economic outlook of the data received over the upcoming intermeeting period. Here we go. Some others, however, judged it unlikely that the information available by the December meeting would warrant raising the target rate for the federal funds rate at that meeting. So we're thinking about raising, but we're not thinking about raising. They go on in further eloquence. Several participants indicated that despite lessening concerns about the implications of recent global economic and financial developments for domestic economic activity and inflation, appreciable downside risks to the outlook remained. Keep in mind, this was before the Paris attacks. They're really still here focusing on China. We now have, obviously, the risk of a European slowdown. Anyway, let's press on. They were concerned about the potential loss of momentum in the economy and the associated possibility that inflation might fail to increase as expected. Such concerns might suggest that the initiation of the normalization process may not yet be warranted. So what the hell are we talking about here? They're not raising rates. I mean, this is very clear. This is pure English here. I mean, some people there, I guess the lackers and the geniuses of the world, of the Fed, the Stan Fishers, the Jeff Lackers, the more hawkish members, I guess, still think it's time. And the doves who have really run the Fed think no. So let's go over what that piece said, that they needed to reach their inflation target, which I hadn't initially caught, but it was stuck in there. We are so far away from that 2%. I think they even said they thought it was 2018 in a past meeting. We all know that there is more overseas risk now with ISIS on the rampage. I've discussed this in past videos. And we've had more deflation. The one thing that concerned me that I didn't see in the statement, and I'm going to have to go back through it because there's some more, is the dollar. That is the real big wild card here. You bet it would bury emerging markets. The strong dollar would bury emerging markets. That's correct. It would also cream earnings. That compounded with more European QE would, first of all, make it more expensive to service our debt here. The Fed wouldn't just be raising rates, they'd be forcing interest rates higher. They would be strengthening the dollar and hurting the economy right into an economic slowdown. We know that the retail earnings from Macy's and Nordy's and all these retailers have been really crappy. I know a lot of it is being blamed on the Amazon effect. I think that there is some percentage of that that is valid, but in general, we know that the numbers aren't that great. And they would be hiking interest rates into a deflationary environment. I actually did a little bit of research on this and came up with the fact that the current trend of inflation now is lower than it was when they did both QE 1, 2, and 3. All three of them. There was more inflation back then than when they did QE, and now that we have less inflation, now they want to tighten? I mean, that to me is, I mean, I don't know. I mean, maybe in bizarro land. That makes no sense to me. And of course, here we go. You know, they're data dependent. This is just some of my notes I wrote down. They're data dependent. One thing that to me struck as a complete kind of a bit of a curveball was that they're worried if they don't hike. This to me, by the way, this is the showstopper of stupidity. They're worried if they don't hike that the markets will interpret that as a lack of confidence. Really? I mean, you're afraid that the market is not going to like you not raising interest rates. So I don't get it. Anyway, why did we rally today? We rallied because of this. This to me, you know, I know the TV. I posted earlier that that the guys on TV, no matter what was said, were going to say it was hawkish. My initial read was a little. I said neutral to more neutral to maybe a little bit more hawkish, but I reread this here. This is really not hawkish. I believe that we are in a lower for longer environment, and I will stick pat on my no interest rates for hikes for 2015 thesis. I could be wrong. There is there is always room for policy error. I think that some of the excuses that were made on TV today were that the Fed could be one and done. I've heard this before, but for me, the real issue, and I've discussed this before on here as well as Twitter in the weekend review videos, is that not so much the amount of the hike, it's the fact that they're switching policies from accommodation to tightening into a slowdown in a deflationary environment. Take a look at that. You know, you want to talk about, we just recently got through Halloween, we're already at Thanksgiving. You want to talk about a horror show, look at the chart for oil or for copper. That isn't, you know, they're so worried, everyone is so worried about theoretical inflation when we have actual real deflation. Deflation, listen, inflation is very easy to tamp down. Look what happened after the dot-com bubble. They raised interest rates, they did the same thing in 2005 through 7, and they created a market crash. Look how easy it was to create deflation after there was inflation. To reflate is a lot harder. They have to do more QE. So my hypothesis has been this for a while, that if we still have the current economic numbers, not even assuming deterioration, although that is a big risk and the Fed seems to be aware of that, I think that the Fed should wait until at least the first quarter. We've had very weak first quarters the last 2 years. We already know that this is going to be a huge discounted retail season. I just bought a pair of Palladium boots the other day on their website, and they were 30% off, and it's not even Black Friday. So, you know, we've had a seasonably warm winter. Sales have not been that great. I think that they are on hold lower for longer. I don't think that there is a hike in 2015. I'll stick to that. I do think that they would be prudent to wait till after the first quarter. After that, you know, I would think that then they could make a better determination. I believe if by summer next year we are still weak, there will be QE4. I'm sticking to my thesis. I'm sorry, it's lower for longer thesis. You know, I'm just a lower for longer kind of guy. So let's see how the data rolls in. I will monitor it and post updates. If I think anything changes, you guys know you'll be the first to know. I will publicly announce. You know, a lot of people dig in on what their beliefs are. If I think for 1 minute I'm wrong, if I'm ever wrong even for 1 minute, I don't want to be wrong. I want to be right. And the only way to be right is to first stop being wrong. So if I change my mind, you guys will know about it, I assure you. But as of now, it's lower for longer. So let me see. Are there any other notes here? Yeah. They did mention the glide path or whatever. They're you know, that the fact that they are going to I've said this for a while, that the rate of normalization isn't going to be as steep as it normally would be, and they usually tend to top out between like 5 and change and 6%. The leaked Fed notes over the summer was exactly on point for me. About 3.5% is the new normal, so to speak. That's pretty low, and it's going to take a while to get there. So believe it or not, even if they do start raising, it could be. I mean, I don't think it's going to be, the ramp like Greenspan, the mistake Greenspan made, but I just don't see why they would do it. Anyway, so one thing that did strike out to me today as a little bit concerning was this. Was Square? That's Jack Dorsey's new baby. The IPO, they priced it in the hole, and I will say this, I believe that was smart, because if that IPO is successful, it will be good not only for Square, but also for Twitter. If Square is a bust, Twitter is going to get smashed, and so is Square, and traders are going to take them both to the woodshed, and then they're going to take it to the woodshed again, and then they're going to take it to the woodshed again. Hello. We have more people joining us. That's good. By the way, if you ever come into this broadcast late, and you want to see it from the beginning, which I always suggest people do, they kind of read from cover to cover. Justin Pulitzer Trades is my YouTube channel. This will be up there this evening. You could rewatch the entire broadcast. Should be following me on Twitter also. My handle is @JustinPulitzer. I'll repeat those again at the end of the broadcast. So the one concern that I had was that there's two ways to look at this. That Square was priced in the hole so that it would be a successful IPO. And the other way to look at it, and this to me is the right way to look at it, is that the window for money for these unicorn types of stocks is slowly closing, and they're rushing to get this out before they can't get it out. That is a big, big concern for me, and we're going to have to see how that plays out. I don't know that's a fact, but it really could be a problem. You can see that the silliness stocks that I've been telling you guys to stay away from, the GoPros, the Ambarellas, all that crap, have been getting creamed. And the reason for that is that they are basically these types of stocks. The Snapchat IPO was just written down, I think, like 25%. That's a pretty big haircut. Things are not well in high multiple land. A lot of that is because of the fear of Fed hikes. When you have interest rates rising, the PE multiples, the amount of money that traders or investors or whatever are willing to pay for forward earnings has to come down. If they are lowering interest rates, those numbers go up. It's sort of like, think about Pleasure Island in Pinocchio land. That's how I see it. More booze, more cigars, more GoPro, less booze, less cigars, less GoPro. Simple. Fitbit slammarooskied with a secondary. I remember I had more people fighting with me on that on the stream, and I said that was GoPro 2.0. Smashed all-time lows, trying to build a base, probably for another leg lower. Not a fan of these stocks, I have to tell you. I will say this, though, that GoPro today I had been projecting, I said 1960, that was the 1.618 Fibonacci extension. You don't believe me? Go roll that beautiful bean footage and go to my my YouTube channel and check out the weekend review. We have achieved that price target, and we put in a bit of a hammer. This could be a bit of an island reversal. If you can get up above today's high, I would say that it's probably a long versus the low of day. So that's... No, when I say someone asked about being priced in the hole, I mean that yes, they're bringing it public at a lower multiple than it was valued at recently. They believe they did some capital raises in the private equity land, and they're actually bringing it public at a discount to where the last round went. Imagine if you were one of those guys, you must be thrilled, right? So that's the story with Square. A couple of things that might not be construed as deflation, although they are, is Sprint cutting their prices in half. I've been saying that Sprint and T-Mobile are leading the way to zero for mobile pricing. It didn't take Verizon and AT&T out to the woodshed today, but those stocks should be slammed. They're going to have to cut prices. I'm actually thinking about even switching to Sprint. I would love to cut my bill in half. I have to see out here in the hinterlands of Williamsburg how how the service is. T-Mobile out here is crappy. I have to see how Sprint is. Thank God, right? For a 30-day return policy, I'll go in, I'll buy one, and if I don't like it, I'll return it. Anyway, so let's get into some of these stocks that we always discuss. First and foremost, this Green Mountain Coffee reported after the bell. That stock had been so badly beaten up that I guess it was due for a bounce. The only problem is the breakdown points were 49 and the gap fill is 50. It's trading 48. It'll probably set up for a right or right out short, actually, now, even on this gap. I think that cold machine they made is the biggest piece of GoPro that I've seen yet. It takes multiple minutes to make a cold. I actually have a, maybe one day I'll do a Periscope of me making SodaStream. I have a SodaStream. I have like the most fancy one with all the buttons and the display. I shouldn't say I barely use it, but I don't use it that much. And when it's fast, I can make multiple bottles. I can do it real fast. That cold, what if I had a party over here? We're going to be waiting, till halftime for a soda. That's ridiculous. Anyway, it's too big. They need to make it smaller and they need to make it faster. So we'll see how that goes. All right, so I had said that Yelp I thought was trading. I had posted on the Twitter that I liked it. Actually, before earnings, I had been short some puts. It didn't do much afterward. I actually resold puts because I was noticing, this is what people always ask me, particularly newer traders, what should I do to get good at trading? I always say learn how to read tape. And that takes a little time. It's sort of like driving stick shift. You need to feel out the gears. So I just felt to me that there was a change in the way that the stock was trading. I think I did the math on the stock. It had been very, people had been asking me in the 40s, is this a takeout candidate? And I kept on saying, you can't speculate on this being a takeout candidate when the fundamentals are deteriorating. Finally, after the stock was cut in half now, down into the 20s, it's worth about $2 billion. That is the magic takeout number, and I actually believe it will happen, as crazy as that sounds. I don't think that that's going to be a zero. I know a lot of people who use Yelp. They're starting to come up now more in Google search. Maybe Google will buy them. I don't know. I don't know if they will. Remember, Priceline bought the other one. What is it? For the reservation, OpenTable. They bought OpenTable. So I do think that there's some value in that Yelp. It could be bought. The nature of the trading changed. I saw that anytime they tried to take it below 25, it was bought right up, and I bought. I sold more puts, and the stock has rallied. It's been doing very well. Another one, 2 days ago, I thought it was yesterday, I misspoke on the Twitter. I was selling puts in Skechers. It got the gap fill. It really achieved my first point. And I took a bit of a nibble in it. I sold some puts. I think I sold, let me tell you, I don't want to cuff it. I want to be really accurate. I sold 25 puts, and I really was looking for it to bottom somewhere between 20 and 21. It max, sort of the max. And it already had come down so much, I was like, this thing has got to be, something. So I sold some puts with the full intention going in. This is a big disciplinary lesson I want to teach here. So pay attention, please. If you are adding to losers of stocks, like you buy and then it goes down, and you buy more and it goes down, that is wrong. However, if you're feeling for the bottom, and this takes experience and discipline, and I guess you kind of have to know the rules to know when you could bend them, and this is a bit of a bend. I was feeling for a bottom near reference lows, and I started off there with the full intention that if it got down lower, that would be my real buy. So this was sort of like the foreplay as opposed to the main course. We're talking about food, right? The appetizer before the main course. So the main course would have been the 20-21. The appetizer was 25. Anyway, that covers that. I still it had double back-to-back hammers. I like that. I thought that would be a good entry point. I'm just trying to keep a straight face, guys. Let's keep it clean. That to me was the buy. So let's go on to what else do I want to cover? Let's just start at the top of the key, right? Let's get into Apple. So Apple today had news. They had a Goldman Sachs upgrade. I will tell you this, my experience is after Apple has reached a new high, has some kind of decline and starts to rally up, Goldman is famous for this, and they tend to mark a big inflection point. It tends to be a gap, a rally the whole day, and then after that, the stock starts to list and fall over. So will that be the case this time? I don't really know. I know that there was there's a gap to fill up around 120. I know that anything below 119.75 to me is a little bit vulnerable. The stock is kind of, it held roughly held an old flash crash level. It roughly held a channel. It's mid-channel here. You're coming to the end of a volume distribution, so I would expect there maybe is a little bit room up to 118s, and then it's sort of a little bit of wait and see. If you're currently long Apple, I wouldn't let it get below 115. That, to me, would be the stop. That has been a very important level for a while, although we've traded around it a lot. But if you start really getting below, it's really 114, but let's just say between 114 and 115, if you really start getting below there, I would be really, really careful with owning Apple. I'd actually probably be playing it short if we broke there. Amazon. So this is in the deep end, really in the deep end of the pool here. It got my target that I had discussed, the 1.618 fib at 660.64. It actually got higher than that. It got up to 675.96. It had like 2 days back to back, and then it just kind of fell apart. I actually was a little bit more concerned about the stock. It didn't even get back to the 619.45, which really would have been the first test of support. It stopped ahead of there, and now it's back up above the 660.64. You know, I guess there's room. There's really room in the channel. I mean, you could really get up into this, believe it or not, up into the 700s, and that's sort of an artificial channel top that I drew. But this is getting a little extended. You know, I would book a little bit of profits. I wouldn't be too greedy in this, but you know, I do believe that they are taking it to retailers. I use Amazon all the time. I'll give you a quick anecdote. I was at a store in my neighborhood the other day. They had a pair of rain shoes I liked for $95. I went on Amazon. They were $75. The store wouldn't match. And before I left the store, they were already ordered from Amazon. So that is the, you know, the showrooming isn't just Best Buy. It's kind of everywhere now. And I don't believe that, you know, it's all over for all of retail. There are still people, you know, like I think particularly for clothing shopping, it really benefits if you can try stuff on. But I do believe that, you know, the Amazon model works. You know, is it worth, you know, a zillion times earning like it trades? I mean, I don't know, but you know, the stock is still pretty strong. If you're kind of looking to do, you know, what to do, you know, use today's range. Anything, or I should say, anything above. All right, let's not cuff it. Let's give anything above 662.26 is to me more bullish. Anything that gets back below 640.45 to me is a short. I just want to see where that hammer body is. Yeah, like anything below 640 to me, I think you can play a short. It should really not be back into that area. All right, so that's this. Facebook, let's cover the Facebook. We love the Facebook. It broke the channel a couple days ago. This is very, very typical action for Facebook. Don't be fooled so quickly. It often has these run-ups on Google, and then it's just really choppy. It looks more bullish than it actually is in range for a few days, and then it falls apart. I don't necessarily know that that's going to be the case here, but I can tell you this, that the stochastics are starting to roll over. They're not through the upper line yet, which to me would be much more bearish. Actually, the best scenario would be for Facebook to blow up here and for the stochastic still to be rolling over, and that would set up for an amazing short, believe it or not, short term. Longer term, I'm very bullish on Facebook. I think the stock can double, believe it or not. But I don't know if that's going to happen right this moment. I would have loved, the pullback got into the hundreds. I really wanted to see the 99s. I would have felt much better about this rally. It was a little bit short. I still think that there's maybe some risk down into the mid to high 90s on a larger pullback, particularly if the market starts to pull over, with 86 kind of being like the line in the sand. I don't know that we're going to get there, but you know, you never know. if there's some flash crash action. I still think the stock looks bullish. I just would like it to consolidate and work off some of these late to the party chasers. Netflix. So the Netflix, I said the other day, I said it looked kind of bullish. I thought that it would get through 115. It did. And there's a little bit more room to the channel top. If it were to do it tomorrow, like on the open, it would be 123. I think my line was like I was looking for like 125, 126 on the move like this, but we'll see how that plays out. I think it probably, as long as it's above 115, it's a long. Anything below there gets iffy, back down to 110 and 105 and 103.88 and all those levels. But anything above 115, 115.03, 115.83. So yeah, anything above 115 to 116 bullish. Anything below there iffy, kind of GTFO. And then play with put spreads or ratios. But I still think it's going to probably want to challenge and maybe have a fib extension of that last high. If that were to happen, let me. I'm just going to measure it out quickly for you guys. Where would that take dear old Netflix? So there's a couple of ways to kind of measure that move here. If you use the flash crash low. That would take us to, not 82.29. That would take us to the moon, actually. It would take you up to 156.35. Holy crap. That could really happen, believe it or not. I know it sounds like a lot, but it really could. 93.55. That would be the first line in the sand. The next one would be, and probably more realistic, because I've been noticing that Fibonacci extensions from the kind of pullback low, not the, when we talk about SPY, the pullback low, we talk about the second one in 187s, not all the way down. If it were to make that fib extension, it's still pretty high. It's 151.38. So maybe. It's very possible. I would not put it past this stock in a moment, particularly if we get some buying into the end of the year. So that to me is, as long as we're above 115, it's a long. Anything below there, little iffy. What else do I want to cover? Let's go into SPY, and this is really going to be the key. And I think we could actually. Maybe we'll end on SPY. This is it. Let's do it real quick. We'll end today. We'll end real early today. So let's end on SPY. I was talking about Fed day ranges, and there being some very important demarcation points. And I don't mean demarc that guy. I just mean levels that are important. And we had Fed minute numbers. That was a bar that I said was important. We had gotten above there, and then I said we use Fed day levels. So today is almost an identical bar to the Fed day. So I will now defer to today's range as above the high of day is bullish, below the low of day is bearish. And getting above 206, today's candle was basically a Maribozo candle, which is pretty bullish. Really, if you hold half of today's gains, that is kind of bullish. I will talk about ES and some of those levels to begin with. But I'll use this as long as we're above the breakout. Really, the breakdown level was 207, and the breakout level today was 207. As long as we can that's a little bit more than half today's move, but as long as we can stay above there, the play is more long. I'd rather be more long than short. Anything below there, I'd rather be a little bit flat or more short. And if we lose today's low of day, which was 205.99, which let's just say 206, it is GTFO and get the heck short. That if we lose today's low, oh man, are we going to be in for it? I think that we will see the 50-day moving average before you could even, bat an eyelash. So that to me is really the key. I will say this. Let's get into ES short term. We're really overbought. We closed like $17 and change over the VWAP. That is roughly 263, so 263, 264, that area. It would not shock me in the least to see that tested in the next, I don't know if it's going to be tomorrow, I don't know if it's going to be next week, but it wouldn't shock me to see that be tested. The Fed gap bar, or I should say the 15-minute bar that the Fed, that was really the range that we needed. The high of that bar was 2073 quarter. The VWAP from the Fed day that we had the rich close was 2069.50. So that is really kind of the maximum that I'm willing to give. If we get below there, it's starting to get iffy because you're back into that bar. So you really need to hold 2069.5 to 2073 quarter. Anything below there is a little bit iffy. Then I think we would for sure see the VWAP. And if we lose the Fed day bar of 2060 quarter, that is a short, an absolute short, and I would expect a complete free fall in the market at that point. So mark those levels. I would be playing right or right out there in size, actually. If we lose that, I will be in size short for a right or right out play. So let's wrap it up. Anyhow, if you want to re-watch this video, my YouTube channel is Justin Pulitzer Trades. You can follow me on Twitter. My handle is @JustinPulitzer. And please leave some comments. I would very much like to get some feedback. If you enjoyed this video, be sure to favorite it and retweet it on Twitter. And please send me questions that you may have. It helps me to, you guys make me better. You help me to shape these videos to be more relevant. And let's have a good week, and cheers. Oh, my email is just my name at Gmail. Simple.